Listen, if you're a brand new investor, there are certain ETFs you should absolutely never buy. Honestly, it's not because they're a scam and it's not because they're illegal. It's because they carry these sneaky, hidden structural risks that nobody really tells you about until, well, you've already lost a massive chunk of your money. Welcome to this explainer. I'm stepping in today not just as your host, but really as a mentor. As someone holding a master's degree in international finance, I want to pull you aside and give you the inside scoop. I've analyzed these financial instruments inside and out, and today I'm going to tell you exactly which types to avoid like the plague, and more importantly, where you should actually be putting your hard-earned cash instead. But hey, before we get into the weeds, we absolutely have to set some ground rules. Investing involves risk. It is not some magic, guaranteed path to getting rich overnight. The stock market can, and definitely will, go down at times. If you don't understand what you're putting your money into, those risks, they multiply exponentially. So treat this explainer as your serious roadmap to protecting your capital. Okay, let's dive right into this. Here is our game plan for today. We're going to cover the hidden ETF traps, the daily reset trap, false crash protection, the silent currency risk, and finally, why boring builds real wealth. All right, kicking things off with Section 1, the hidden ETF traps. You know, when you first start investing, it is so incredibly tempting to just find whatever ETF had amazing recent performance and blindly hit buy. You kind of feel like a genius doing it. But these dangerous instruments often hide behind totally normal, boring-sounding ETF names. So here's what you probably didn't realize you were buying. There are 3 massive traps beginners fall into when they chase those high returns without getting the underlying mechanics: leverage risk, volatility decay, and currency exposure. These 3 traps are routinely bundled right into funds that look totally standard on the surface. Seriously, if you own any ETFs right now, stick with me to the very end because this matters more than almost anything else you'll learn starting out. Moving right along to Section 2, the daily reset trap. So you've probably seen those leveraged ETFs, right? The ones flashing 2x or 3x in the name, promising double or triple the daily return of the market. Sounds like a total fast track to wealth. But here is the massive trap: volatility decay. Basically, this is the mathematical erosion of your returns over time, and it's caused entirely by the fund resetting its leverage target every single day. Let's use a super simple analogy. Imagine you're trying to walk up a really steep hill. You take 3 steps forward, but then gravity shifts and violently pulls you 4 steps back. That 3x magic, it only works cleanly for one single isolated day. Over weeks and months of the market naturally bouncing up and down, that daily reset absolutely destroys your wealth. And this brings us to the stark contrast between the one-day illusion and the long-term reality. The illusion is insanely appealing. I get it. Making 3% when the market only goes up 1% feels like you've literally hacked the system. But the long-term reality, it is brutal. These are absolutely 100% not long-term investment instruments. They are highly specialized, extremely short-term trading tools designed for institutional pros who are running very specific hedging strategies. So you might be wondering, just how much damage can this actually do to a beginner's portfolio? Well, take a look at this number, 80%. That's right. And this isn't some hypothetical doom and gloom worst-case scenario. This is real life. Let me show you exactly how this played out. Think back to 2022. The tech-heavy NASDAQ index had a genuinely rough year. It fell 33%. A tough pill to swallow, for sure, but totally normal in the grand scheme of investing. But what about the beginners holding that 3x leveraged NASDAQ ETF, hoping for a super fast rebound? That fund plummeted over 80%. See, it didn't just fall 3 times that 33% drop. It fell way, way worse because of how volatility decay and reverse compounding mathematically chewed through their capital, day after day, downswing after downswing. Tragically, most beginners don't learn this lesson until their account is completely decimated. Now, warning number 2 is basically the flip side of that same coin. Section 3, false crash protection. Enter the inverse ETF. These are explicitly designed to go up when the market goes down. They're heavily marketed to anxious beginners as the ultimate protection. People buy them thinking, hey, I'm intelligently hedging against a crash. But let's look at the reality here. They suffer from the exact same daily reset problem we just talked about. Volatility decay absolutely eats them alive. If you hold an inverse ETF for a whole year, even if the market is perfectly flat and doesn't crash at all, you can still lose 20 to 30% of your money. That's not a loss from a market crash. That is a structural loss baked directly into the fund's daily math. They're sold as a safety net, but man, they are a trap. If you ever see someone in a random finance forum hyping up an inverse ETF as a safe long-term hold, that is your giant, flashing red flag to walk away. As your mentor here, let me tell you what real structural safety actually looks like. Honestly, it's boring, but it works. Keeping adequate cash reserves for emergencies, holding broad, unleveraged index funds, and just having a long time horizon so you can simply ride out those temporary market dips.
All right, moving to Section 4, the silent currency risk. Now, this is exactly the kind of nuance my international finance degree trained me to watch out for. Imagine you're a small investor logging in from Norway or the UK, Europe, really anywhere outside the US. If you buy a US-only ETF, your returns aren't just based on how well those US companies perform. No, your returns are exposed to two entirely different variables at once: the actual stock market performance and the exchange rate between your local currency and the US dollar. So if your US ETF goes up by 10%, but the US dollar weakens by 10% against your local currency, well, you make absolutely nothing. You just break even. Now, for a quick one-year trade, a net zero currency swing, meh, it's perfectly manageable. But we are talking about building life-changing wealth over decades here. Over a 30-year investment horizon, severe currency swings can silently erase years of your hard-earned gains. A lack of global diversification is literally a silent killer for long-term wealth. But by holding a globally diversified fund, you spread your money across dozens of different currencies. That completely neutralizes the risk of any single currency collapsing and taking your entire retirement down with it.
Which brings us beautifully to Section 5. Boring builds real wealth.
Okay, take a deep breath. We made it through the scary traps. Let's shift gears and look at the safe harbor. What actually works? Here are 3 specific examples of highly diversified, ultra-low-cost funds that completely sidestep every single trap we just talked about. First up, for total global exposure, you have VWCE. It holds companies from over 50 countries and has a tiny 0.22% expense ratio. If one currency drops, who cares? You own the whole world. Next, for non-US investors wanting super clean S&P 500 exposure, there's CSPX. It's highly efficient, zero leverage, and has a microscopic 0.07% cost. And for the US-based investors watching, VOO. It's the purest version of the US market with a rock-bottom 0.03% fee. These are your safe alternative.
These funds represent what I love to call the safe standard. They pass literally every test for a beginner. No 2x or 3x leverage nonsense, no daily reset mechanics mathematically chewing up your capital, no hidden, highly concentrated currency traps, extremely low costs, and they are broadly, widely diversified. Honestly, just applying these simple, clean filters covers like 90% of what any beginner retail investor actually needs to do to succeed. I want to leave you with a little personal insight from the professional side of the finance world. The pros? They know that avoiding short-term leverage trading is the actual secret sauce. Keep it boring. That's actually how wealth gets built. The excitement shouldn't be in your portfolio's daily wild swings. The excitement should be looking at your account 20 years from now and realizing that patience, low costs, and true diversification actually worked.
I have seen way too many beginners get caught in these traps, just staring at their screens, wondering why the math never added up. And that's exactly why I love breaking this stuff down for you. So, I have a question for you right now to make sure you're on the right track. What ETFs are currently sitting in your portfolio? Seriously, drop your ticker symbols in the comments below. Let's do a real, honest, mentor-led portfolio check to see if your investments pass the 3 filter tests we laid out today. Keep learning, stay disciplined, and I will see you in the next explainer.